Today, I want to talk about benchmarks, and I thought this was interesting. Brian St. Paul, our marketing manager, titled this "A Crash Course in Cherry Picking," I believe implying that, not that we would do this, but perhaps investment managers might choose to position their investment services in a way to make their results look as good as possible. We have no interest in that, but our competitors might do that. So at the end of the day, it's very good for you as consumers of investment management to understand this, and I kind of entertained myself a lot putting together some examples for you, and hopefully you'll find some of this somewhat interesting. Now, one thing even before we get into benchmarks, and I realize I don't even have a slide for this, when you're evaluating an investment manager, there's, I like to call, 3 P's that you ought to really be paying attention to. The first is investment process. And these guys are going to be talking a lot and giving you some insights into the various parts of our investment process. That's very important. The next is people. Who is doing the work in terms of investing? Are they the folks that actually generated the returns you look at? And then the last is performance. And usually when we talk performance, we get into talking about benchmarks. And there's a couple of uses for benchmarks. One is to help set investor expectations for risk and reward. So if you study a firm's benchmark, it's going to give you hopefully a good idea of what you could expect as they're managing money for you. And we tend to look past this very, very important aspect of benchmarking. And then the last, and the one that everyone talks about, that I've written about a lot, that I go around the country speaking about, is using benchmarks to evaluate portfolio performance. And I think we'll drill down into this for a few minutes this morning. And hopefully I can give you some insights into what's going on here. So there's a couple of types of benchmarks, and there are absolute and relative return benchmarks. And absolute benchmarks, in this case, using your retirement goal as a benchmark, is something we get to uniquely do at Pinnacle because we are a financial planning firm as well as an investment firm. And here we're just illustrating your current wealth, and you have your financial goal, and as you move up towards your financial goal, isn't that great? A happy face, we're all happy. As you move up towards your financial goal, you can kind of track, and the good news is it gives you a number, a dollar figure to target. The bad news is this type of a benchmark doesn't work very well because it doesn't really take into consideration what goes on in financial markets. And the other thing about using retirement as a benchmark is just, or a financial planning goal, is that your own behavior gets into this. So there's no way of evaluating whether you saved the amount of money you were supposed to save, whether you overspent or whether you oversaved, all those things that get into whether or not you make it out here to where we're aiming. So it's an interesting benchmark. It's one that you can have, to have a target of 2 million, 4 million, 10 million, whatever your target is. Something to keep in mind, but maybe not the best investment benchmark. Notice it keeps going up. I love that. Clearly a bull market. Thank you, Brian. Another type of absolute benchmark is your investment policy benchmark. And again, this is something we provide for you at Pinnacle. Very interesting. I was talking with Michael Kitsis about this yesterday, and actually this is in many ways very much related to the first benchmark. These benchmarks in your investment policy statement are tied to an inflation premium, and they're built after studying about 30 years of history of financial markets. And here I'm illustrating the moderate growth portfolio and its benchmark, which is inflation plus 5, and historically from October of 2002, and you'll see these numbers October of 2002, that's the inception of our GIPS compliant portfolio presentations. From October of 2002 till now, you can see that that portfolio has done very much like what we would have expected. If I had done your financial plan back in 2002 and said you're going to do inflation plus 5. But you'll also notice that for a long period of time we floated over that number, and so I guess we were heroic. Then in the bear market we came dramatically under. So once again you have a benchmark here that is not tied to the actual movements of the financial markets themselves. And so maybe for most investors, this is something to keep in your back pocket. I think this whole notion is important as a benchmark, probably not the benchmark that most consumers of investment advice are focused on. So let's move from some absolute benchmarks to relative benchmarks, comparing portfolio performance to something else. And there's two types of relative benchmarks I wanted to talk to you about this morning. One is our competitive universe. We could compare to other active managers. And then the other type of benchmark is the one that we've used for years, where we compare to a benchmark that we build out of asset classes. And this morning we'll build one together, and I'll have fun with this. You may be bored to death, but I'm telling you, I think it's hilarious. We can do this. So the first thing I thought I'd do is suggest, if you were going to try and figure out what would be a good competitive universe to compare our performance to, what would be a good active management universe, I'm just going to throw out there, maybe the hedge fund universe is a good universe to look at. I mean, hedge funds are very typically famous for being unconstrained, being able to invest anywhere in the world. So I thought I'd pick a couple of choices to use as a benchmark for that universe. This is the Credit Suisse Hedge Fund Index, and as you can see, it has funds with a minimum of $10 million under management. It represents this universe, at least 85% of the assets under management in the universe. So I would suggest to you this is probably a pretty good institutional index, institutional quality benchmark for active management. So let's take another look at another one. This is the HFRX Global Hedge Fund Index. Again, a completely different index, but again, I think very solid and defensible. It includes convertible large, distressed securities, equity market neutral, and so forth. So we have a choice then, hypothetically. I actually don't believe there's any good competitive universe to compare us to. But if we were to choose one of these, which one might we choose? Which one might any money manager choose? And surprisingly, even though these are both institutional quality indexes, representative of active managers, look at the difference of performance. There's almost 100% difference in performance over this period of time, beginning October to October 13. So clearly, if we were going to choose a benchmark to show you our performance versus our competitive universe, it would be, of course, this one, where our portfolios, DMG and DA, floating well above, delivering hundreds of % more return, as opposed to if we were going to compare to this one. And I can assure you that as a consumer, you need to be aware that the selection of the index that's used to represent an asset class is just an important thing to understand. And while but anyway, so it's something that we pay a lot of attention to. And then the last thing that I just want to mention, and I hope you can see this in the back. Can you see these dots and squares? It's all good? Okay, is that we often look at performance without looking at risk. And so today I'm going to be showing you a lot of scatter charts. Famously, you all at Pinnacle, if you've been here, are used to seeing these. So we have return on the vertical axis. We have risk down here. So here are our two hedge fund indexes, one with a higher return than another. We outperformed both, but we took more risk. You wouldn't see that on the other side. Okay, so now that we've kind of explored this idea of indexes and asset classes, I thought we should review together before we build some benchmarks what our palette of choices is, what are out there that we could use to build benchmarks. So we're going to start out with cash and the S&P 500 index, and then I'm just going to bring in some other asset classes that are institutional quality asset classes we might want to use in building a benchmark. So now you have international stocks. You can see slightly higher returns with slightly more risk. And then as we go through, I'm going to go through these quickly. Can you see this down here? So these are commodities. Okay, over here you have bonds. Up top, you have emerging markets. Now, this time frame is since inception, so we're looking at that same October of 02 through current. What did I just put up here? The Russell 2000 small caps. There's the Global Hedge Fund Index. This dot line there, that's U.S. real estate. It's an index of REITs. This is high yield, Barclays high yield bonds. These are international bonds, and then finally up there is gold. So these are all asset classes that are on our palette. We could consider using these to build a benchmark for you. And I thought what I'd do is kind of revisit lesson we learned last year, which is, well, our perception of these as being good or bad, high risk or low risk, changes with the regime we look at. So here, first of all, let's just highlight a few of these and we'll see their relationship change. So I took the lowest one, cash, I took the best one, emerging markets, and I took the one over here that looked like it had the best risk-adjusted return, which is junk bonds. And we'll take a look at these in different regimes. So this is the bull market from 02 to 07. And you can see that emerging is still up here, cash is still down here, junk is in this area here. But some of the relationships begin to change as we look at different time frames. This is the bear market of 07 to 09. Now you see some dramatic changes. Our perception of these asset classes in a benchmark would change dramatically. Cash is now, as you would expect, way up here. Gold floats to the top. Look what's right down at the bottom. Very high risk emerging markets with very low returns. Real estate even lower with even more risk. So things change and our perceptions change versus the regime we're in. Here's our three things. You would see here junk bonds, which look really good in bull markets, don't look so great. In bear markets, they decline 20% over that period. And then the last regime is the current regime, the current bull market, where again, once again, what you see is emerging markets not doing so well in this particular period. I think Carl will have much to say about this. And you can see the different relationships as they change. So with that, let's go ahead and build a benchmark. And I thought it would be instructive here to take a look at, I love the way Brian put this, a famous competitor's benchmark. Brad Pitt is famous. Okay, this competitor is not so famous, but they are well known in the institutional investment world. And there are a couple points I thought I would make. This is their actual choice of benchmarks. And a couple things that caught my eye that I thought would be interesting just as a matter of we're all learning about this together. First of all, this competitor offers investors two different benchmarks. They offer a global series of benchmarks, depending on what strategy you're in, and then they offer you a blended benchmark. So the notion that there's two is kind of interesting to me. The other thing is that their blended benchmark they offer is a benchmark you all may recognize from, if you've been with Pinnacle for 8 years, we actually use this exact benchmark for a good 8 years. Very simple two asset class benchmark. But I think what caught my eye most about this is the labels and the titles, and this is something you need to be aware of. So let's take a look. Here's their conservative portfolio. Their benchmark is 20% in equities, and they happen to use a kind of a blended index for this, the MSCI All Country World Index. I don't have a problem with that. But look at their growth index, which is 55% of equities and 5% commodities. At Pinnacle, we would clearly call this our moderate portfolio. But the label here is growth. So you would have to be looking to see how are they actually investing this portfolio. Our growth benchmark has 75% equities as the benchmark. So if they're investing with a lot more equities and they're comparing to a benchmark that has 60% risk assets, you could see that you would expect them to be able to show higher returns. And it's just a lesson here of don't be fooled by the labels. What they show as global aggressive, which is 70% in stocks and 10% in commodities, our aggressive is 100% in equities. So you have to be careful and understand what you're looking at. All right, so I went ahead and built 3 different benchmarks for you. The first one has 2 asset classes. That's the one we just looked at. This is just stocks and bonds, 60-40. Then I built you a 5 asset class benchmark. This is our current benchmark we're using. It's made up of large caps, international developed, commodities, cash. It's not labeled, but I promise you this is bonds right there. And then I took one just for grants. I said, let's take all of the high risk, high return asset classes on our palette, and let's build them all into a benchmark. So now you have lots of pie slices. It includes all of these asset classes, and we build in all the risk and all the return. And I thought we'd just compare the benchmarks to each other. I thought you might find this to be somewhat interesting. So over that since inception time frame, look what happens. The 11 asset class benchmark that has all the risk and return, not surprisingly, floats way out here on the risk spectrum, okay? Way up here in the return spectrum. The other 2 benchmarks are kind of here. Why would this be important? Well, if investment firm is trying to show you and compare risk-adjusted performance, you would be interested in how much risk. These are much easier benchmarks, or this is a much easier benchmark to beat if you're considering risk in your analysis. These are harder because they take much less risk. So let's look at the different regimes again, just to see how these relationships. Now the 5 asset class benchmark takes dramatically less risk. Isn't that interesting? The returns are all in a narrow range, but from a risk perspective, you get to see something different. Okay, in the bear market, now the 2 asset class benchmark, these two are in the same kind of risk category. Now you see the 11 asset class benchmark, way out as we might expect. Much, much more risk, much lower returns because of the types of assets we selected to be in the benchmark. If you're choosing to compare to any one of these, you get different results depending on the benchmark you select. Okay, it doesn't matter what your performance stayed the same, but you're making choices in benchmarks. And then finally, this is the last bull market, and again, you see this difference, the 2 asset class flows up and whatever. What's interesting about showing you risk and reward is that if we just look at reward, look what happens. They don't look all that different, do they? They look kind of the same. So having looked at all those scatter charts and seen these differences, when you put the whole thing together and you run it out, it doesn't look like it's that meaningful. And for most of us, unfortunately, we evaluate portfolio performance in terms of return, and we probably don't spend enough time on risk. Since Pinnacle's in the risk management business, that's something that we would like all of us to spend a little more time and attention on. Okay, so some concluding comments. It's not a bullet point on here, but as I mentioned, performance is only one of 3 things you should be looking at. You should be looking at process, people, and then performance. Absolute benchmarks have their place here at Pinnacle. We're pleased to be able to offer you help with that because we are your financial planner and you can help you develop targets for your absolute wealth. With relative benchmarks, you have to understand the components that make up your benchmark. And we looked at some examples of that and how you can get to different conclusions based on the choices that investment firms give you. And yes, companies can make their performance look better or worse with their benchmark choices. So that's just part of the game that we have as consumers. And time frames matter. Your perception of what is good and bad will change as we look at different time horizons. One of the things we talked about last year is that we're looking at various regimes, and today we are looking at all of our results in a 5-year bull market, and it's important to look at a complete market cycle.